Hello, I'm Dominic Hobson, co-founder of the Future of Finance. My guest today is Jeff Hartjes, Executive Business Manager at 21X, the regulated blockchain-based digital asset exchange, which is licensed to trade under the DLT pilot regime of the European Union. As a business at the forefront of on-chain trading and settlement, the recent experience and views on current issues of 21X, as a pioneer of tokenized securities and funds, is invaluable for everyone who believes we need a new system of finance and investment. Jeff, thank you very much for sharing time with us.
Thank you, Dominic. Thank you for being here, and yeah, thanks for the invite. Looking forward to this session.
Stablecoins are obviously the hot topic at the moment. They're proliferating, and there's a lot of enthusiasm and positive sentiment towards them. Now, when it comes to operating an exchange, they're obviously useful to settle the cash leg of transactions on chain, including across currencies. But do you worry that the lack of interoperability between stablecoins, between chains, blockchains, is going to undermine their ability to generate liquidity?
So currently, I'm not at all worried about the lack of interoperability. If you look at many of the stable coins that are out there today and that are micro-regulated, many of them, as of today, already support multiple chains, like Circle or Unity. It will be interesting, and this you can phrase this not just for stable coins, but for all assets and for an entire multi-chain system, how all of these stable coins or tokens, asset tokens on these multiple chains will become or get into one pool that can be used on each and every chain. And I'm really looking forward what solutions there are. I know there are already people like Chainlink and others working on these interoperability solution also for unified liquidity. And but I'm not scared. I think there is multiple solutions towards this, and yeah, we will see a lot more of the stablecoin players moving to multiple chains, and yeah, I think that's the first step when it comes to bringing these stablecoin or digital asset markets to life.
There were a couple of other exciting pieces of news for the tokenization markets before Christmas. The DTCC announced its tokenization pilot in the United States, various restrictions on the DLT pilot regime in the EU, under which you are licensed. The lifting of those restrictions, plus this news from the DTCC, were seen by many observers of the marketplace as true game changers. Do you agree with that? Do you think that measures such as this are going to increase token issuance and give your users many more assets to trade?
So that's a very good question, Dominic. So I think the DTCC tokenization pilot in general by itself will already create yeah, more token issuances. I think that's clear. But coming back to you calling them the game changers, I think we will see many more of those game changers throughout 2026. For me, another game changer, at least for a certain part of the financial industry, in this case the CSDs, was just announced yesterday with the allowance here in Europe of the ECB to accept tokenized assets as collateral. And I also see this as a major game changer, especially for a lot of the traditional finance yeah, market participants. And yeah, this will for sure be a push again for the entire market. And so yes, DTCC announcements like yesterday with ECB and many more announcements will in the next case move market participants to issue more products, and for sure, some of those products will definitely also going to be listed on 21X. You can guess that. Maybe not all, but at least some of them will be on public chain and will completely fall into our strategy. And yeah, and so those will be assets that are coming and moving towards trading on a DLT TSS by this year. So yeah, sure. Game changers are here. We're just recording this in January, and yeah, we are just seeing game changers already for 2026, and I'm pretty sure there are more game changers from market participants understanding that there is no way around DLT market infrastructure and digital assets anymore, and therefore pushing with own offers into the market.
Can I ask you, when we look at the token markets, about the balance between the issuance of tokenized funds and the issuance of tokenized securities? You could argue that tokenized funds have proved a more uh, promising avenue of growth for the token markets in the last year or two. Do you see tokenized funds as a more promising avenue for growth at 21X in particular than, say, corporates or public agencies issuing tokenized securities?
Yeah. So, what I would like to mention is, especially if you go a couple of years backwards, you will see that it some of the first issuances started with tokenized corporate bonds. I always like to mention the Siemens bond that was issued here in Germany on a tokenized infrastructure. But there have been the first steps when it comes to these the first products, especially here in Europe. Was really corporate bonds paving the way. And what we have now seen in 2025, and I would say also in 2024, is the first products from the fund industry, tokenized funds, especially the money market funds. But yeah, we have seen a lot more than that. And yeah, my overall view on this is the money market funds are still essential for everyone in the tokenized financial world, because this is the way to easily earn interest, which you don't have with the stable coins as of now, neither here nor in the US. And yeah, I think we have seen in the past the first corporates moving into the world of tokenized corporate bonds. And I also think that this will move ahead, but it is a little bit slower. Corporates will take a little bit more time, and also by the requests that we have seen from the market, there is an increasing number of asset managers in the meantime, because they are closer to these products and also to the technology. There is more and more interest of them also issuing tokenized securities and tokenizing further funds, and not just money market funds. So I'm really looking forward to this piece. I think we will see a lot more funds today, and this year especially. But we won't see the let's say we won't see the 15th tokenized money market fund. There will be a little bit competition between the existing money market fund space when it comes to interest rates and how they are set up, and are they natively tokenized? What is the value? How quickly do I get the settlement? How quickly do I get in and out of these funds? Is it really keeping the benefits that tokenization has promised us all the times? because that in the end also has something to do with the asset and the asset exchange that you're working with, and if it is working similar to 21x and offering T plus zero, and if that is all the case, we will not see too many more money market funds. There will be a point where the interest is moving to other fund structures, to other products, and I think we are very very close to be seeing exactly that evolution into competitive money market funds, and then into the next other product categories.
Blockchain protocols are not irrelevant here. You sometimes hear from institutional issuers, institutional investors, that one of the obstacles to them getting deeply involved in token markets is they're not sure which blockchain protocol is the right one. We've touched on the question of interoperability, which would obviously make that go away, but they sometimes say, well, we've got to choose the winning blockchain protocol. Now, 21x itself has had made some interesting decisions here. When you were first set up, you chose Polygon, but the organization is now pursuing a multi-chain strategy. Which protocols do you see as 21x as succeeding at generating the sort of business you want to attract as an exchange?
Yeah. So maybe just a couple of words on why we choose Polygon. I think back then we handed in the license application. Um, and from my perspective and from my knowledge back at the time, there were not a lot of RWAs and tokenized instruments out there in the market. So we were especially looking at what are other organizations doing, and from a corporate and also financial institution perspective, Polygon was back then the most chosen opportunity for a lot of the players in the market. And yeah, it also had a lot of benefits when it comes to block time and yeah, and that in the end was the reason why we chose Polygon. If we would look again, and if you would look at the the list of points that we internally are looking at when choosing a protocol, then out of how the market in the meantime has performed and behaved, maybe today we wouldn't choose Polygon anymore, because as you can see, a lot of the financial institutions have done money market funds on different protocols like Stellar. There is a lot of attention also for Solana. There is and are a lot of products on Avalanche, and I would say from a public chain perspective, these three are right now the ones which are from an RWA perspective the ones that are top notch. Nevertheless, this is not the only factor that we're looking at. We're also looking at how many transactions does a network support, also technical components, and it would be bad to not also mention Base from Coinbase here. I think they are when it comes to that, they are also very interesting. But with all I've just said, I've just mentioned public chains. And I think if you look into the market, you will see a lot of institutionals that are moving towards private chains. And overall, I have to say we are technology agnostic. Yeah, we will go wherever the majority of our clients are. And if tomorrow the outcome of our research is everything is happening on private chains, we will also have our look into that. But for now, we still see the clear move of a lot of institutionals to public chains, because this is the real benefit in the technological infrastructure. But in the end, we are where our clients are or will be, and this is yeah,
Mm.
whatever chain this requires to be. And yeah, that's I think that's the most important case for each and every company to be successful is to listen to their clients and to be and take care of exactly this piece.
Mm. The the range and variety of public and private blockchains is not the only reason that institutional clients and potential institutional clients are adopting a conservative approach to tokenization. They're also concerned about asset safety or custody, safe custody. How difficult are you finding it to accommodate the demand of institutional money for, uh, if you like, old-fashioned
Mm.
custody products? How well does that integrate with digital wallet technology? How can you satisfy them that a digital wallet is just as safe as a large global custodian bank?
It's this is exactly a very interesting question. I think if you have had a look and not just an eye but also an ear into the market in the past years, you could have witnessed that
Hmm.
a lot of the really traditional players are yeah, I don't want to say are feared, but are really stepping or taking a step back and waiting for everyone else in the market to make the first move. And there are some players that really look into public chain. There are some based on their nature that are looking into private chain. And if I may come back to the yeah to the soul of your question. I think when you look at especially the custody of assets of stablecoins, etc. I think it's fair to say we are allowed for self custody, but I don't know any institutional that will be allowed or able to go the way of self custody. We might be looking into that for a certain number of corporates or for smaller clients for foundations for whatsoever there this might be possible, but especially when it comes to the safety of their assets, you just need to have a look into the market. There's two major options right now. The first one is everyone is either building their own custody setup, sometimes even their own technology stack for that. And the second part is they are partnering with one of the major custody providers to ensure the same level of safekeeping as in the traditional world, so to say. Yeah. And surely, if you compare this some of these informations also today if you go with a traditional CSD um, is already on cloud infrastructure, sometimes on private chain infrastructure, and when it comes to the security of especially the token asset or the instrument, I would say blockchain and blockchain solutions are doing a very good job, and the custody providers, technical custody providers, are doing a very good job here to get as close as possible. Also with the certifications that they're getting, with the tests and security runs also that we are having with the likes of Hacken and other participants. I think we are very good in, and this industry is especially in this institutional space is becoming very good in the safekeeping and safety. Surely there will be differences to the traditional world. That's clear, and also surely there will be some players that will never or that maybe never move into this space. Yeah. because it is just not part of their internal policies, or not part of their strategy, and they see it as, or are too risk averse to make any move. So we won't see some of the players for a long time in this space, while others will use the first mover advantage and the opportunity.
One final obstacle, which is often put up by institutional money, I will raise with you, and this is liquidity. I'm not sure liquidity is quite the right word. Better to talk about activity or even network effects, I think. But what people mean by this is that if you're an institutional issuer, you want to be confident there'll be people there to buy the liabilities that you're issuing. If you're an institutional investor, you want to be confident that you can actually sell the liabilities which you have purchased. What is 21X doing to provide that liquidity in terms of attracting market makers and other forms of liquidity provision?
Yeah. So looking at the market makers that we have been in contact with and that are working for us today, um, so first of all, their job is pretty similar to on traditional markets. They are filling our central limit order book on chain, yeah, with orders. So and for that part, obviously similar or completely identical to traditional markets, they get paid. Some have, how can I say it? Some have different structures and models there on taking a certain amount of the spread. Some want some of the BIP that is asking for, that someone is asking for in this trades, and so on and so forth. So there's different models in that to really attract market makers and liquidity providers. Surely, it is also here, with the direct transaction or exchange of asset um, and yeah, the stable coin, or the tokenized money, you can say that with this direct exchange, there are differences to the today's world. People, and especially the market maker, needs to immediately have the money at the place or the asset at the place, and so there is differences to how market making and liquidity provision works today. Nevertheless, also these differences, and I like to say this also a lot when it comes to other parts, for example, when it comes to corporates that are able to go in and out in T+0 into our money market funds. I also like to say this for the market makers. With a lot of the other players, this is not possible. So if we would move immediately into this entirely tokenized world, no one would say, "Hey, this is an issue that I need the assets, or the stable coins as the prerequisite for the trade to take place," because everything would happen instant, and you could do a lot more, and you could do some new business. You have some new business opportunities by also following this route. That's what I see. Some market makers have understood this. Some liquidities providers have understood this. That's why they are early in the market, and that's why they are working with us. And some yet need to understand where the market is going, and still need time to build up their strategy and how this is going to look like. But nevertheless, also there, giving a technical update, we're also working on different solutions so that the asset at the time of the trade does not be the prerequisite, so that there is a special especially solutions for market makers and liquidity providers to have an intermediate step into this new world, if you want to say so, and just giving this as a slight update. So also their technology is evolving, and yeah, we are moving towards an a completely tokenized financial market also, with market makers going to provide the right amounts, yeah, there.
Okay, my very last question. I'm going to invite you to make rather unfairly make a prediction about this question of liquidity, activity, network effects, if you like.
Yeah.
You've pointed out that many of your participants are watching carefully to see how the market evolves. They've noticed that the technology is changing, the techniques are changing. So if I was to invite you to make a prediction about how activity, liquidity, network effects will be generated on markets such as 21x, would you say that we are moving away from the traditional model you described? And many people will be surprised that you've described market makers operating inside digital asset markets in much the same way as they operated inside traditional stock markets, collecting a spread between the bid and offer. And that model is clearly happening and working. On the other hand, you have got this new class of liquidity providers, which are not into or new form of liquidity provision is a better way of putting it, which is not intermediated by an organization such as a market maker. You've got issuers meeting investors, traders meeting traders directly. The prediction I want you to make is if you look 5, 10 years ahead, do you think that the traditional market making model is going to gradually disappear and be replaced by something much more unintermediated, much more automated, and much more data rich, much more driven by data, I guess? What would you what would your forecast be for the structure of liquidity provision in the token markets of the future?
Yeah. So maybe also a little bit on the background that I'm seeing. So what we're having right now is we have a lot of traditional market makers that know how traditional market making works. Then we have crypto market makers that start to understand how financial instruments and market making for financial instruments work. Then we have what you just described. Um, we will have the likes of exchanges, crypto exchanges, potentially being connected, sitting on stable coins that they earn in their trading fees, and with the ability to put these stable coins into trades themselves to go into certain products. Then you have the corporates that we're directly addressing, over really directly addressing to go into our products and out. Then you have, as you described, you have over third-party providers, you have direct retailers, traders interacting. You have the investor being active, maybe buying certain amounts of their shares, or if it's a company later on, buying shares back as a company decision. So you have a lot of direct intermediate or direct participants in this setup. And yeah, also furthermore, what you described, you also will have somewhere in the future some of these players might work with agents, and I don't want to focus too much on these, but um, yeah, everyone can think of doing an automated transaction, or having a simple algorithm saying, if I have in my ERP system, if I have a certain amount over the amount that I need for the bills, then please put it into a money market fund. I think this is simple, and if I need a certain amount back, please ask, or put something into to get the money back. And I think if you look at this, then the liquidity in those markets are similar, or are in certain senses similar to traditional markets because there you also have market making. You don't have automated market making. You have high frequency trading and so on and so forth. So there are other options, I would say, right now for this liquidity topic. But I also clearly see that the traditional players, they are moving into this market. The crypto players, they are looking at digital instruments. And you can pick every one of those that I just mentioned, and everyone is having a look at this tokenized instruments. And by all of them coming together into one market, you create this flywheel of liquidity with all those participants. And in the end, I can just pick the assumption that this is really one of the main drivers of everyone having access to the same source, to the same infrastructure, to the same assets, that this is really one of the key plays and the key roles for an end game, and why this is moving digital asset markets also forward in 2026.
You've described very well the complexity, the messiness, if you like, of the transition from the world we've known to the world we all hope for. But you're putting on it a clear vision of a sense of momentum in the direction of tokenization. So, Jeff Hartjes, thank you very much for sharing your knowledge and your insights with the members of Future of Finance.
Thank you. Pleasure.